Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. How you going? Thanks for joining us on the podcast today. It's a pleasure as you join us on this journey that we're all embarking along, trying to create wealth through property, and we're really in an interesting situation right now. I did a live stream recently on the Smart Property Investment Show. Go and check it out. It was around life after the federal election, and we had some great guests on the live stream. Rob Mello, he's from BIS, Oxford Economics, Paul Glossop from Pure Property Investment, and one of my colleagues here, Katarina Turian. And we actually had a look at what's going to happen to property markets subsequent to the coalition coming in. There's a whole bunch of questions we didn't really get onto, and one theme of questions in particular was around financing moving forward. After the Morrison government was elected into power, it's now a couple of weeks ago, feels a lifetime ago, the share market rallied. It was up sort of 1.3, 1.4% by memory the day after, the first day trading after the election. So obviously some confidence in the market around the health and security of Australia's economy moving forward. For property investors, there's still a lot going on in terms of setting their goals and sort of setting the agenda or the tactics they're going to use to drive wealth through property moving forward, particularly around this finance bit. Now, what I'm hearing from the market, and there's a bit coming through, is that the government regulators, in particular APRA, is having a discussion with the banks, trying to sort of get them to soften serviceability a little bit and try and get some movements happening in financial markets. But it's a bit outside my pay grade. So I've asked someone to come in that knows about this sort of stuff. Redom Syed. It's the third time he's been on the podcast. He's a mortgage broker. He's from a business called Confidence Finance, and his background is he's ex-Treasury, so he sort of gets the understandings of how Treasury sits there and plays its role in helping to shape policy decisions with the regulator and policymakers, and he's also got his finger on the pulse about what's going on. Redom, how you going, mate? You well?
Good, Phil. Cheers. Thanks for having me.
So it's a bit of a long-winded introduction, but I just wanted to sort of set the scene. We have we have the same government, but the first time we have an elected government now, Scott Morrison, who picked it up from Turnbull back in August last year, re-elected in a bit of a surprise to most of Australia. It wasn't really a surprise to us here at Momentum Media, which is the brand behind Smart Property Investment. We sort of, all our brands sort of picked that the Liberal National Party would come back into power, but I didn't really stand out there and say that before. I could have told everyone that was going to happen, but I didn't. But property investors are pretty happy by and large around it, and we've sort of covered it already. We did it on the webcast. We've also done it a bit on the podcast. What we know is that negative gearing is going to remain as it is right now, so it's not going to change. Changes to CGT discounts, it's going to stay as it is. And also for mortgage brokers, guys like yourself, a lot more confidence in the way in which you guys are going to be remunerated. So there's a lot of things in the favours for the property investors right now. They have a confidence that mortgage brokers are going to be dedicated to keep growing this channel. And just a bit of context, 60% of all mortgages now are written through mortgage brokers. But this bit around getting finance, last year was hard to get finance. It's been hard to get finance this year, and we've done that to death, so I don't want to go back over it. But what are you seeing now in the market in terms of getting finance? Is it getting easier?
Yeah, look, that's a really good question in the sense that you're asking about the now. So you raised in your introduction that APRA have signalled, and more specifically, they've written a letter to the banks saying that to effectively allow borrowers to borrow more. And this is across the board for everyone. An assessment rate change, what they're suggesting is a change that gives everyone roughly between 7 to 20% more in additional borrowing power, depending on how the changes flow through and what interest rate changes happen. So that is a proposed change for probably the next 6 months, and it'll probably start taking effect in the next couple months. So that proposed change, when it does happen, is going to have a pretty big substantial boost to lending, and it's probably the first time in the last 3 to 5 years that the pendulum has swung, where they're no longer tightening lending, they're loosening lending, and the loosening process is actually quite strong. A couple rate cuts, an assessment rate change. This isn't a small action by a regulator at all. It's a big monetary stimulus helping boost borrowing power and making the cost of funding significantly cheaper. And that drives affordability, it drives demand. And theoretically, the economics behind it is when you cut interest rates and you allow people to borrow more, nominal values of assets, including stocks and property, go up. And the stock market, which is liquid, gets to reflect that relatively quickly, which is part of the boost in stock markets over the last few weeks. And property markets, Sydney and Melbourne had its first positive weekly reading on the CoreLogic Index last week, in the first week after Morrison. That hasn't happened for 2 years. So CBA is reporting a 10% increase in weekly applications as well. And, as a mortgage broker, our inquiry levels are going up. Real estate agents are reporting the same thing. So confidence is back. Whether it's sustained or not is a little bit unknown because it's very recent. But there's some changes that have happened.
So let's just unravel this a little bit. So I've just tuned into this podcast and gone, I have no idea what these two guys are talking about, right? So let's just put a couple of pegs in the ground to help shape people's decision-making or understanding of what we're talking about right now. So APRA, who is APRA? What does APRA do?
So APRA are the prudential regulator in Australia. So their job is to promote financial stability. And for property investors, what they need to know is APRA sets the rules for what banks are allowed to do when they assess your mortgage application. So when you go into a bank and decide, hey, I want to borrow money, what does the bank do? How the bank makes their decision is framed by what APRA allows them to do.
Okay, so APRA makes recommendations that the banks hope to follow. And when you look at what's happened in property markets recently, after the peaks of sort of 2015, we're talking Sydney and Melbourne, a lot of the downturn in property markets was orchestrated by, what do you want to call it, intervention by APRA into how banks look at the serviceability of borrowers. So they put recommendations in place that changed the way in which a bank would look at a borrower and work out how much money you could do. So that was orchestrated. It was policy driven, the downturn in property markets, to try and take some heat out of the market. And that took effect, and the job has been done. So we're at a point right now where they're looking to unwind some of those inhibitors for the market, and that's good for property investors. So APRA sets the rules, and banks like to lend money. I think a lot of people go, banks don't want to lend money because it's really hard to get. No, if banks like lending money to people who should be getting money, right?
Yes, they do. That's how they make money. So they're incentivized to, when APRA tells them that they can lend more, they're incentivized to lend more. That's just market profit motive working. And when APRA says to do it, they're likely to do it. When APRA also tells them to tighten their lending, it's kind of like the policeman knocking on your door telling you to do something. You kind of do it. And that's what APRA is to banks, a little bit of a policeman to how they approach mortgage lending.
And banks will push it out as much as they can. And a lot of the restrictions placed on lenders over the last couple of years, which was APRA-led, was around restricting the amount of money going through to property investors and them not growing their interest-only books too quickly or their books to investors too quickly. So that's starting to soften a bit. So it's good for property investors. In conjunction with this is confidence, and to your point around the state of the economy, the health of the economy under a Morrison government. Now, we're going to throw into the mix, and that's going to shape the way in which investors might approach borrowing moving forward, is that a number of economic forecasters and economists are calling for a number of rate cuts on the horizon. Do you subscribe to this?
Yeah, actually I do. I came in January and I said at the time that regulators might spook this year and the growing fears of the housing market might drive action to reduce interest rates. Now it looks like almost a near market certainty that they're going to cut rates. I may have just put my foot in it if they don't, but at least that's what the market's predicting and that's what economists are predicting. And going further, Bill Evans, one of the best predictors of interest rates, typically in the past from Westpac, has predicted 3 rate cuts in the next 5 RBA meetings. So that's a pretty substantial change. If that does happen, that's a pretty substantial change to the cost of debt. So yeah, I don't believe the economists are wrong in this sense. I don't know how many rate cuts there'll be, but I'd be very surprised if there's not one. I'd be very surprised if there's not at least one rate cut in June and possibly a couple more later this year.
So I want to ask you about what happens with rate cuts and what it means for property investors. But before we go any further, Redom, I just want to cut to a quick break. Welcome back, everyone. We're having a chat about potential for interest rate cuts right now and what it might mean for property investors. I'm here with Redom Syed. If the Reserve Bank cuts interest rates, does that guarantee or necessarily mean that the borrower will get a cheaper rate? Is that how it works? That's how I guess we all would like it to work.
Yeah, theoretically, yes. Because funding costs have come down for banks, so the cost at which banks operate in and how much they have to pay to get money has come down. This then gets passed on to borrowers. So when the cost of business goes lower, they pass that on. And what borrowers should see is when the RBA cuts rates, their rate comes down, at least for variable rate mortgages. And we're also seeing fixed rate products come tumbling down, really. They've come down nearly 50 basis points this year. So effectively, for borrowers and for Australians, what they really need to know is interest rates are lower now, and we're now experiencing the lowest interest rates in Australia ever. And that has an impact on affordability because it means that people can borrow at a lower rate and their repayments lower. So the amount of income that they need to use to service their mortgages is a lower percentage of their overall income, and hence their affordability goes up. Also, prices have come down 10, 15% in Sydney and Melbourne. So that's another thing that helps affordability. And these are normal parts of a cycle. I think when things go up, affordability comes down. When things go down, affordability goes up, and then the market sort of achieves equilibrium over time. So that's how interest rates promote demand for housing. If you're sitting there as a mum and dad, you're just sitting there, running your numbers, you realize, oh, hang on, I'm spending this much on my mortgage. It's come down. Perhaps I can move into the next suburb closer, or if I'm a first home buyer, maybe I can extend it a little bit more because I can afford it. And that's really how interest rates drive the incentives to help people purchase property and assets in general.
What's the sharpest rate you're getting for interest only for variable for investors right now?
Yeah, so that particular product for an interest-only variable loan is in the early 4% range at the moment. Okay. That's for smaller lenders, a little bit cheaper than the bigger lenders, and the bigger lenders are probably in the mid-4s. It's the most expensive product on the market, at least for standard residential mortgages.
Yeah.
It's really cross-subsidising the cheaper mortgages, the owner-occupier P&I mortgages, which is around 3.7. Interest-only investors sort of cross-subsidising those loans. So yeah, the cheaper products in the early 4% range, and fixed products are a little bit cheaper.
And there's potential for that coming down with interest rate cuts. You would expect that.
Exactly.
So investors sitting there thinking about their investment strategy moving forward. The conversation I had with Rob Mellor, who is the Managing Director and Chief Economist at BIS, Oxford Economics, he has called the bottom of the market within sort of 2 to 3 months in Sydney, Sydney and Melbourne, right? I subscribe to that. Other people say likewise. So put you on the spot in terms of your maths. For every $100,000 you borrow, interest only, at 4%, say for example, $4,000 a year. Is my math correct? It's about right, isn't it?
Yep, that's good.
So you're borrowing $300,000. That's $12,000 a year in cost to service debt.
Roughly, yep.
And that hopefully might come down a little bit. So a lot of people sitting there thinking, you think, oh yeah, $12,000. If you're getting rent, a lot of it's manageable for a lot of people. So we're talking about housing. We're talking about investment affordability here. So a lot of the people that tune into this podcast aren't necessarily high income earners. So they might be on $50,000, $60,000, which sort of is average now. That doesn't make property investment outside the realm of most people. If you are planned and focused and have a strategy, you can actually get into the market.
Yeah, no, that's definitely true. There are options to get into the market at lower incomes as well. Obviously, you'll need to adjust your investing strategy a little bit. You probably need a little bit more yield. If you have a high income, you can probably absorb a loss or less rental income through your own savings. But when you're on a lower income, it's probably a little bit hard for you to be making out-of-pocket expenses every month. So you're probably looking for a better rental income ratio to the property value to help you manage those repayments and the affordability. So it's just a different strategy, but there are definitely options in the market for that.
So the people that you're working with right now, securing finance, are they aware that things are starting to change a little bit? Are you getting increased interest in investing in property now that all these things have been ticked off, election and all this sort of stuff?
Yeah, I'd say post-election there's been a little bit more, there's been a demand increase. Whether that's confidence of the election going away, or whether it's potential interest rate cuts or the APRA changes, or a combination of the trifecta of these three changes that have been sort of announced over the last couple of weeks. I'm not too sure exactly, but there's definitely been an increase in confidence in the housing market over the last couple of weeks, and that's starting to play out. And it may come to bear in the week of June 7, around then, when the interest rate gets announced. I think that's on June 4. And if there's an interest rate cut then that following weekend usually sees a spike in demand as well. So that might be a weekend to watch in terms of what actually happens on the ground in the marketplace. Behavior starts changing when interest rates get cut. So that would be a real good confidence reader.
So what are the smart investors doing at the moment in preparation for these changes?
Yeah, that's a good question. So we're getting asked a lot by relatively sophisticated investors as to what the potential APRA changes mean for them. And that's a good question to ask at this stage, even though it's not in place at the moment, because it means that their borrowing power increases. And it might mean that if you've been out of the market because you can't borrow, you might be at the margins where these changes mean you can borrow. So a really good example, just giving you some quick numbers, that for a property investor, let's just say they've got a few property investments and they've got about 2 million in debt, which is a fair bit. They're a pretty advanced property investor. That person might be capped out at that point, can't get any more money from any of the banks. Now that person will probably get roughly a $300,000 to $400,000 increase in their borrowing power for investing from these APRA changes. Now that might mean an additional property or two, and that's a change that brings them back into the market because they're probably likely, they exhibit behaviors that suggest that they want to grow their portfolio but haven't been able to because of financing. But now they're back and they're accessing funding at relatively low interest rates. So that conversation is one that smart investors are starting to have now with their finance team. And we'll see that come to bear over the course of the next 6 months.
So can you just crystallise, and I should have touched on it earlier, but what the changes are, what the recommended changes are from APRA? It's around how they approach serviceability, is that right?
Exactly. So what they're trying to do is change the assessment rate that banks use to determine how much they lend to you. So this specifically means that when you go and apply for a loan with a bank, they assess whether you can meet repayments currently at 7%, 7.25% principal and interest. Now they're going to reduce that amount to 2.5% above the interest rate you pay. So that effectively, on a mortgage that costs roughly 4%, that brings the assessment rate down to 6.5%. Now add in a couple rate cuts, you might bring the assessment rate down to 6%. And if you do that, you combine the impacts of all of that, you have that borrowing power increase that I just mentioned. Our numbers suggest, on average, the average borrower across the board, whether you're an investor, whether you're an owner-occupier, first-home buyer, you're seeing a 12% increase on your borrowing power from where it was the day before to the day after these changes get implemented. It obviously depends on what the interest rate is, and the level of change depends on how much of the flow-through goes to the borrower.
I want to have a chat to you about preparing your finances to actually capitalise on changing environment. We're just going to throw to a quick break. We'll be back with you in just a moment. Okay, we're back with the Smart Property Investment Show. Now, Redom, I really want to get into capitalising on this changing environment and securing finance. So, hypothetical, you've been locked out of the market now because of serviceability for 6 months, 1 year, whatever length of time it is. Hopefully during that period, you've been saving your money, so you're ready to roll. If not, hopefully your property's gone up in value, so you've got some equity you can draw down on. How do you make sure your finances are as tight as possible so when you do look to secure new mortgage finance, you can be as speedy as possible to secure that?
The big change, this is a pretty substantial change from the last few years, is when you go back to apply for a loan with a bank, it's quite likely that they're going to trawl through your expense statements. So previously, banks would have taken your declaration in the past or their own minimum.
It's like a HEM thing, right? What does HEM stand for again?
Household expenditure method.
Okay, so that's just some algorithm they use to work out how much money you spend. The typical person spends.
Yeah. So it's used to calculate your living expenses, things that you just spend day to day.
So like cigarettes and bourbon, that sort of stuff.
For those inclined. For those inclined. Or groceries and childcare. That's probably the more common ones. But yes, essentially that's what living expenses captures. So the one big change is a lot of lenders are going to look through your credit card statements and your living and your day-to-day transaction accounts to see whether your expenses are in line with what you declare. And that's probably a noticeable change that a lot of borrowers will be like, this is a bit different. Why are they asking me all these questions and why are they taking so long? Because obviously that process is quite substantial if they're looking through all of your expenditures. So that's one change, and it's probably worth investors preparing for that. So that means adjusting your living expenses accordingly.
So at least show 3 months that you can actually live within a means if you had debt on. So 3 months is a pretty good period of time. Because I think also some lenders will take into effect I know some people like saying, I will change the way I do stuff, and you make a commitment to it, and they'll take that into consideration as well, some lenders. Very few.
Yeah. So that's probably not how they're supposed to look at it, and they don't theoretically look at it like that. They look at your actual expenses, but they do take explanation. So, that in itself is probably a weak explanation. But if you explain that, hey, I went on a holiday or my expenditures are higher for this particular reason, that's a good reason. And banks do take that into account. And this is one of the big changes we're seeing in the first 6 months of this year, where there has been increased flexibility in lending. Lenders are making better decisions and they're making more risk-conscious decisions than they did in the past. ANZ's a really good bank in this example because in 2018, they sort of freaked out. And whenever they saw anything that looked a little bit funny, they just said no, or they came up with a really slow, painful decision-making process, and that turned buyers away. So Shane Elliott, the CEO, has come out publicly and said, look, we kind of got this wrong through the Royal Commission process and overdid it a little bit. But now they're back and they're making decisions quite quickly and using common sense and applying some judgments that they need to when you actually make these decisions. And what helps on the market, makes things go quicker, makes people feel more confident when they're buying, makes people get pre-approvals, things like that. And that helps the market.
So this goes back to the point I made that banks love to spend, to lend money, right?
Yes.
If you look at any banks' annual reports or quarterly reports or whatever they are, half-yearly reports, you'll see that the business of mortgages, particularly the stuff coming through mortgage brokers, it's good business for them, right? It's good business. They want to lend money. So you want to make it as easy as possible for a bank to say yes.
Yes, exactly.
Is the best way you can approach financing. And a mortgage broker, and a good mortgage broker in particular, should be able to help you present the absolute best scenario to make it easy for a bank to say yes the first time.
Yeah, exactly.
They love that stuff, right?
Yeah, exactly. That's the advice that you get from your broker or your finance.
So start working. If you're thinking about doing anything this year, at least, and even early into next year, start spending wisely, start showing some good savings, make sure you don't default on anything, all this, but just basic common sense stuff, right?
Sure. That's it. And maybe one more addition to that is maybe you need to wait a little bit for this, but start factoring in the fact that you're going to see that rough 12% increase in your borrowing power, and it might be worth having those conversations with your representatives about whether they can work out what that actually means for you, because for different consumer groups, it's going to mean different things. It might mean you can borrow for another investment property. It might mean you can move into the next suburb. It might mean, you don't borrow that at all. So the implications of these changes are going to be different for different borrowers. Distributionally, they kind of help Sydney and Melbourne the most because the way it works is when you ask for more debt, the more of a benefit you get because it's an assessment rate change. So it's targeting higher debt households, and that's typically Sydney and Melbourne because house prices are higher. So people have higher debt ratios here in these two capitals versus other countries.
You're Sydney-based, aren't you?
I'm Sydney-based, yeah.
Most of your clients investors?
Yeah, I'd say so. Yeah, I'd say so.
What sort of stuff are they buying at the moment?
That's a good question. We're seeing a lot more in Sydney. So what we're seeing in Sydney as well is conditions that remind me a little bit of 2016 where I pick up the phone at the beginning of the day and they tell me that they're starting a negotiation on a property. They think it's probably going to sell for 900. By the end of the day, they're paying, close to 10% above that. And it's multiple bidders just driving up the price. I don't know exactly what the fair market value of that particular property is, but we've had nearly half a dozen conversations like that this week. So what we're finding is there's multiple bidders for the same property. There's a low level of existing stock at the moment, at least for existing dwellings. So home buyers are paying a little bit more now, whether that reflects in the data or not. At least this week, they're paying a little bit more than they would have 2 or 3 weeks ago, and that probably reflects in the data over time.
So it summarises, there's more confidence returning to market, more investors, more buyers in there. And
pretty much, yeah.
And when that happens, there's a consequence to price increases until supply and demand sort of equilibrium. And if property prices start going up, you'll find that people who've been sitting on their property in terms of vendors looking to sell over the last year or so, not getting the prices that they wanted, will start coming back in the market, and then the cycle just starts beefing up. And I might get some auctioneers in over the coming weeks or guys selling real estate because they should start giving some ground truth exactly what they're seeing.
I'd say after June.
The anecdotal stuff I've heard is what the picture you've just painted in terms of there is positive price pressure properties. And when you look at some of these properties that have been sitting on the market for quite some time, whether they've been marketed inappropriately or the vendor expectations weren't realistic, that will catch up and we'll start seeing these things move forward. But so to close then, you got one word to say to property investors right across Australia about this market moving forward, what would it be?
One word.
One sentence. One
word would be
one
boom.
comment.
Probably.
Okay, boom. You reckon?
If I need to pick a word like confidence, boom, good times.
Boom. You reckon boom?
I would say in the short term, yes.
Yeah.
Rate cuts, like this is what they do. Rate cuts drive people to buy property. There's more people looking to buy, so prices go up, demand goes up, and supply takes time to react. So using common sense there and using the economics of demand and supply, if I needed to pick a word, prices go up. So boom is probably a good way to say that. It's a one-word summary if that's what you want.
That's fine. Well, he's called a boom. It's a good headline for us, right?
I wouldn't necessarily call it a property boom per se, but I would say that
explosion of interest.
Yeah. That's probably a better way to explain it. But in one word, yes, confidence is back.
And what are you up to? Are you buying at the moment?
Personally, no. I'm probably one of those investors that have made my decisions and decided to pay down debt now. But yeah, that's me personally. I might adjust my strategy with all of this change happening, but I'm already exposed to it. So yeah.
And hypothetical, if you had some cash and you're ready to go, where would you be looking? And it depends on the price point, but
Truth be told, I think this is a little bit of a strange one, but I think in the short run, I'd probably be looking at premium Sydney. So areas that are in the $1.5 to $2.5 million price bracket. So if I was looking to upgrade my PPOR, there's a lot of Sydney siders. That sounds like a lot of money when you think of it. When people are going to hear this, they'll think that. But in Sydney, that is a lot of suburbs. And I think those markets, because of these changes and because of interest rate changes, it really targets them. So the people who are buying in those markets are probably going to see an increase in demand in a ring. Sydney and Melbourne will likely see a bit of a demand increase because of this. And those areas typically have supply constraints too.
Okay. And where's most of your stuff now? Your investment properties?
Across Sydney and Brisbane.
Brisbane.
Yeah.
What do you think about Brisbane? Something going to happen there? Everyone's talking about boom. Everyone's been waiting for patiently, myself included.
I'm not too sure whether there's going to be a boom there, but interest rate changes help everywhere. It doesn't discriminate. So Brisbane should see some benefits from that too.
Okay, and then when you're back on the podcast again, instead of say a year's time, what do you think you're going to be talking about? What's this conversation going to be?
I think we're going to see an environment that's very different to today, where confidence is back and probably prices are a little bit higher than where they are right now. And maybe people will actually be saying the word boom and meaning it. I don't necessarily know, but it's starting to swing in that direction rather than slow down.
Okay, well, when you come back in, we'll play that and we'll see how we go.
we'll see.
Thanks for coming again. I know it's you've been on a couple of times this year, so I appreciate the time and coming to share your particular skill set around this and particularly on the mortgage land. So really, really beneficial. Thank you.
Cheers. Pleasure, Phil.
Remember to check out smartpropertyinvestment.com.au. If you're not subscribing yet to our daily morning newsletter, so you're the first to know what's happening in property and property investment right across Australia, irrespective of where you're located or where you're buying, smartpropertyinvestment.com.au/subscribe. If you like what we're doing with this podcast, 2 things that you need to know. Number 1, come on as a guest, whether you got 1 property or 100 properties, whether you're 18 years old or 80 years old, we'd like to tell everyone's story. So you can get in touch with the team, editor at smartpropertyinvestment.com.au, and also click the subscribe button wherever you listen to this so you make sure you get every new episode as it comes online. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.